In this video, I'm going to share with you the top 5 questions you should ask before investing in high-risk investment areas. Hi everyone, I'm Martin Bamford. As an investor, it's important for me to make sure I've done my research and I'm confident enough about a potential investment so that I don't end up losing my money. Legendary investor Warren Buffett famously said, rule number 1, never lose money. Rule number 2, never forget rule number 1. So today, we're going to talk about the top 5 questions you need to ask yourself before making any investments, especially high-risk investments. These are crucial steps in order to protect your wealth and financial future from being lost forever. City regulator, the Financial Conduct Authority, has shared new research into better understanding investors who engage in high-risk investments, stuff like cryptocurrencies and foreign exchange or forex trading. We've seen a significant growth in this high-risk speculative investment activity in the last year. It's driven by multiple factors, including how easy it is to trade using online apps, having some spare cash due to pandemic restrictions, having more time on our hands being stuck at home, and being influenced by lifestyle content on social media. According to this research, a new, younger, more diverse group of investors get involved with these high-risk investments. I believe it's a good thing that new investors are getting stuck in, gaining experience of investing money. However, I'm also very concerned about the many failing to understand the risks involved, which is something backed up by this research. The FCA found that these higher risk investment products are not always suitable, with 59% of new investors claiming that a significant investment loss would have a fundamental impact on their current or future lifestyle. When it comes to investing money and understanding the risks involved, we typically talk about 3 main types of risk to consider. There's your attitude towards investment risk, how you feel about it, and whether investing in a certain way would keep you awake at night. That's the first aspect to consider. There's your need for investment risk, how much risk you need to take with your money in order to achieve your financial goals. And then the third one is your capacity for risk or your capacity for loss. And it's this risk capacity that the FCA is identifying in its research as being poorly considered by almost 2/3 of new investors who engage in these high-risk investments. According to the research, many investors like investing in higher risk assets because of the thrill of investing and also social factors, this sense of ownership in the companies in which they invest. That suggests that some new investors are thrill or status seekers. Their motivation for investing is to get that emotional buzz that comes from the roller coaster ride of investing in volatile assets, and also the status that comes with being an investor or a day trader. There's nothing wrong with these investment motivations as long as you can afford to lose money, which brings us back to capacity for risk. Whenever I speak to investors, I urge them to think very carefully about their reasons for investing money. How much risk do they need to take to achieve their goals in life? How much risk do they feel comfortable taking with their money? How much risk can they afford to take before it has a detrimental effect on their current or future lifestyle? For those investing in higher risk assets, things like Bitcoin or Forex trading, they seem to like the challenge, competition and novelty involved. That finding is worth exploring just a little bit further. As soon as you stray off the beaten track when it comes to investing money, dabbling with things like Forex or crypto, you have to keep in mind that it is a challenge to make money. It's a challenge to avoid losing money. Around 3/4 of retail investors who trade using CFDs, contract for difference, a financial instrument offered via lots of these trading platforms, they lose money during the course of the year. For a quarter or so who make money, the majority are making tiny amounts. One study of day traders in Brazil found that only 1% made more than the minimum wage. And in terms of competition, keep in mind that you are competing with the big boys, the big girls. A question that I like to ask people who are thinking about day trading or Forex trading is this: are you really smarter than an entire trading floor at a large investment bank? The odds are absolutely stacked against you. You're on the other side of each trade against large institutions who are well-resourced, have better access to information than you, and in some cases spend millions of pounds on fast internet connections so they can shave milliseconds off each trade to beat the competition. You're in a losing position before you even get started. There's novelty involved, sure, but novelty isn't necessarily a good thing. Curiosity killed the cat after all. The FCA research found that 38% of newer investors didn't list a single functional reason for investing investing in their top 3 reasons for investing. Sheldon Mills, Executive Director, Consumer and Competition at the FCA, said, "Much of the consumer investments market meets consumers' needs, but we are worried that some investors are being tempted, often through online adverts or high-pressure sales tactics, into buying higher-risk products that are very unlikely to be suitable for them." This research has helped us better understand what drives and motivates consumers so we can tell them about the risks involved in these investments through our investment harm campaign. We want to make sure that we encourage the ability to save and invest for lifetime events, particularly for younger generations, but it is imperative that consumers do so with savings and investment products that have a suitable level of risk for their needs. Investors need to be mindful of their overall risk appetite, diversifying their investments and only investing money they can afford to lose in high-risk products. We also hope our research will provide valuable insights for other organisations that are involved in tackling harm in this market. This research from the FCA found that investors often have high confidence and claimed knowledge, and that's not my experience seeing newbie investors sharing their tips and trades on social media platforms, including TikTok. The knowledge gaps are pretty shocking, even for the most basic concepts. Just yesterday, we saw an example on Twitter of someone claiming to be a wealth management expert, suggesting that the £20,000 ISA allowance was £20,000 of tax-free income each year, rather than a shelter from income tax and capital gains tax on profits made within that tax wrapper. Look, unless you've studied for professional qualifications from the CISI or the CII Chartered Insurance Institute or any number of professional bodies, and unless you have years of relevant experience in investment markets, then you most likely have no place sharing your tips or trades with others. In some cases, you're breaking the law by doing so if you stray into making recommendations for specific investments or specific investment platforms. More than 4 in 10 of those surveyed by the FCA didn't view losing some money as one of the risks of investing. Really? The risk of losing money or a capital loss absolutely goes hand in hand with investing money, especially if you opt for higher risk, more speculative investments, and that does include cryptocurrency, day trading, or Forex. Be prepared to lose your money. One issue here might well be that of luck and timing. For newer investors who got started within the past 12 months, it's been pretty easy to make money. In fact, you would have struggled to go wrong. The trick then is understanding the difference between being lucky and timing or skill. Making money in a bull market, especially the later stages of this bull market with so much euphoria around, it's no special thing. Wealth preservation during bouts of market volatility and the ability to repeat your investing success over longer periods of time, that's where it gets harder. The FCA pointed out that in some cases, investors can lose more than they originally invested. One example is with contract for difference investments. Yes, you can lose more than your initial stake, although the platforms that offer these investment instruments to retail investors, they tend to also offer stop-loss tools, or they sell you out of your position automatically if it would mean that you owe them more than you originally invested. The FCA found that new investors have a strong reliance on gut instinct and rules of thumb, with 78% agreeing to the statement, "I trust my instincts to tell me when it's time to buy and to sell." And 78% also agreeing, "There are certain investment types, sectors or companies I consider a safe bet." Trusting your instincts is a bad idea. Consider the fundamental factors that drive investment valuations instead. The number of new investors who I see relying on the voodoo of technical trading analysis, even applying that approach to Bitcoin or other crypto, which doesn't share the same characteristics as real investments. It's just scary. It is voodoo. The FCA research findings indicate that this newer audience of investors has a more diverse set of characteristics than traditional investors. They tend to skew more towards being female, under 40, and from a BAME background. This newer group of self-investors are more reliant on contemporary media, so YouTube or social media such as TikTok, for tips and news. This trend appears to be prompted by the accessibility offered by the new investing apps. Once again, it's a good thing, in my opinion, that newer investors are getting into investing money, but it's definitely a good thing that this group of people are more diverse. But investment professionals don't want to see the first experience this group has of investing to be an overwhelmingly bad experience. Younger investors typically have the lowest levels of financial resilience before they start investing. As a result, they're more vulnerable to investment losses. The research showed that a significant loss could have a fundamental lifestyle impact on 59% of self-directed investors, those with less than 3 years of experience, and they're more likely to own high-risk investment products. That's compared with 38% of investors with greater than 3 years experience. Along with its research findings, the FCA has restated that tackling harm in consumer investment markets is a regulatory priority. This research, which was carried out by Britain Thinks, is going to drive the FCA's work in the consumer investment market, helping them to design a new campaign to address the harm caused from investors in high-risk, potentially high-return illiquid investments that may not be suitable for their needs. Alongside the publication of this research, the FCA has today launched its digital disruption campaign to prevent investment harm. The campaign uses online advertising to disrupt investors' journeys and drive them to the high return investments webpage. I'll link to that in the description. It covers key questions that consumers should ask before investing money. The FCA advises consumers to consider 5 important questions before they invest. Am I comfortable with the level of risk? Do I fully understand the investment being offered to me? Am I protected if things go wrong? Are my investments regulated? Should I get investment or financial advice? These are great questions, and I would urge you to think about these and ask yourself those questions before making any investment decision. When you think about the level of investment risk involved, please think about risk in terms of your attitude towards investment risk, how much risk you need to take in order to achieve your goals in life, and how much risk you're able to take, that capacity for risk or loss. Understanding the investment is also so important. I really can't understate the importance of that one. Part of the investment philosophy we follow at my firm of chartered financial planners is making sure that our clients understand every aspect of their investment portfolio. It's a test that I always apply to the various investment opportunities that come across my desk. If I can't fully understand the investment with my qualifications and experience behind me to aid in that understanding, then it has no place in our client portfolios. Am I protected if things go wrong? That's another great question. As we've seen recently with the failure of Football Index and then buy-to-let cars, both of which I've made videos about, there is no consumer protection in place when unregulated investment schemes collapse. If you stick to regulated providers and regulated investments, you benefit from the safety net of the Financial Services Compensation Scheme. This question ties into understanding whether or not your investments are regulated. We saw this with Football Index, which was regulated by the Gambling Commission, but not by the Financial Conduct Authority, and then with buy-to-let cars, which was unregulated. If you stray from regulated investments, you lose so many layers of consumer protection. And should you seek financial advice before making an investment? Yes, I know that financial advice is expensive, but it's also incredibly valuable. Start thinking about financial advice in terms of the value added rather than just the cost involved. If financial advice helps you to avoid losing your money, then that's probably a price worth paying. Do you ask yourself these 5 questions before investing money? If you're a self-directed investor, someone who invests money without seeking advice, I would especially like to hear your views about this FCA research and their findings. Do leave a comment below. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.